Okay, 28th of February, Rudy here. Hopefully you're a current investor in VAS or you're thinking about investing in VAS. I've got some interesting observations on why you don't want to invest in VAS but you want to invest in other sectors of the ASX through the use of shares or ETFs. And this can apply to your super fund or money outside of your super fund. Okay, so here's VAS. Nothing wrong with it. In case you didn't know, the VAS is basically, we've got two big indices, the financials and the resources, of which the gold is a little subsector of resources, industrials, healthcare, consumer discretionary, real estate, and energy, and there's a few other little ones, but essentially that's what makes up the ASX. Okay, and that looks very nice, but there's three sectors that if you tilted towards it, you would have made more money and will make more money. So if we look at the first of those sectors, this is our materials index. So all our big miners basically. So this is the ASX 200 materials index, which I have a nice little target, short-term target of up here. So what we do is we use ratios to determine where we should be investing. So if we take that materials index and we divide it by the VAS, there we are. Okay, and I should say, so we're looking at monthly charts. Okay, so you see here 2012. So what this means here is VAS was outperforming. So that number, as that number gets bigger, it's going up faster than the materials. So you want it to be in VAS. And then there's been this rounding top. And then back here on July 25 is when you wanted to switch from VAS to materials. And if you did that complete switch of VAS to a materials ETF, you'd have an extra 40% in your kitty. And so as you can see, this pattern is lining up for, multiples of outperformance over VAS. If you have a portfolio, we do have ETFs, both here in Australia and the US if you're interested, or you can put a little share portfolio that resembles the XMJ. So then we've got another sector which I'm very bullish at the moment, which hasn't broken out, which is our energy sector. So just think like Woodside. So it hasn't done anything, but it's got a lovely rounded bottom, basing pattern, reverse head and shoulders for those that are into that. And we're about to break out. And if we compare the energy sector to VAS, when you're ready, okay, and get the ASX version of it. Okay, so you can see you hadn't wanted to be in the energy sector. You just wanted to be in VAS because VAS has outperformed it. See that? So you would have lost. If you had all, you would have lost a lot of money. Not lost. You would have lost underperformance. So VAS is where you wanted to be. Okay, but you can see we're forming this lovely little breakout here of XEJ over VAS. Okay, so again, there's shares and ETFs you can invest in to take, and so this hasn't even started yet, so you are literally getting in on the ground floor. And then the third sector I like, which is the XGD, which is purely our gold mining sector, which again you can buy ETFs to represent this. And this started back in, well, that's when I started this channel actually. It was February 25 when I saw all this action and no one talking about it. And if we compare that, so the gold index over VAS, you ready? Okay, so make sure we got the ASX version. ASX. Okay, so we're on the ASX. So you can see here again, VAS was outperforming the gold miners, so you didn't want to be in it. But since, well, really, let's just say from February 25 to now, you would have doubled what you had in VAS. Doubled. So if you had 50 grand in VAS and it grew, you'd have 100 grand if you had to switch to XGD. So, and this will continue to outperform. So I'm just throwing it out there. If you want ideas like that, $10 a month sort of costs to join the channel. And we go through basically ASX and US shares and ETFs, stuff you can do in your super fund like Oz Super, Host Plus, or self-managed super, or you can do your own retail fund with stakes super and buy US ETFs, etc. Anyway, join the channel and find out, and I hope you found that interesting.